January begins a new era in U.S. politics, with the Democrats now leading both houses, the House of Representatives and the Senate, albeit with a very slim margin. Yet that still means more fiscal flexibility, at least for the next 2 years. And it means, therefore, a bit more fiscal support to the global outlook, which for us was already relatively positive based on a number of factors. One, obviously, the central banks are still far away from their inflation target. They're still far away from maximizing employment. And they have already announced a number of times that they would continue to be stimulative from a monetary perspective. The vaccines, we've seen continued good news in terms of the efficacy of the vaccine, and that will continue to be rolled out more aggressively in 2021. So that means reopening of the global economy in 2021. And related to that, with the fiscal support the governments have made, consumers have a lot of pent-up demand, and their disposable income is relatively high, and savings rates is relatively high. So if we do get, which is what our scenario is, a reopening of the global economy with pent-up demand, with supporting fiscal and monetary policy, that brings us with a fairly strong continued recovery for 2021 in the order of 7% on global growth, which is very high by historical norms. And very supportive for financial markets. Of course, there are some risks to keep in mind. From a logistical point of view, the vaccine distribution, there could be some hiccup in the distribution and slow down the reopening. There could always be a new strain of the virus where the vaccine would be less effective. We don't see that right now, but that could be the case. And comparatively speaking, on a positive note, with Biden administration, we would probably have a little less geopolitical tension, where there'd be a bit more cooperation around the world. And so that could be also supportive from that perspective. The last one would be maybe a surprise, given the strong pent-up demand, the strong recovery. We would have a resurgence of inflation a little faster than expected, which would force the hand of central banks to move away from their accommodative stance. So the economic environment that I just described is fairly supportive for financial markets. We have to take into account 2020, there was a large recovery. So the recovery in 2021 will continue, but perhaps a bit more muted. We see short-term interest rates remaining towards zero, at least for the next 12 to 18 months. The yield curve, as growth continues to improve, the yield curve, the long end of the curve, would continue to move up. And while corporate spreads and high yield spreads and emerging market bonds would continue to do relatively okay, the capital gains part will be less, because it'll be difficult for them to rally in an environment where rates at the long end are backing up. On the equity side, still fairly positive. The recovery, though, means the rotation that had started in 2020 will continue in 2021. That is, non-US stocks continue to outperform US stocks. Small cap stocks have a good chance of continue to outperform large cap stock in 21, as well as cyclical outperforming the more defensive part of the equity market. So those would be important positioning for investors in 2021. Finally, this environment is conducive to a weaker US dollar in general. That means stronger Canadian dollar to continue in 21. And there's also a good opportunity for emerging market currencies in high yielding countries to continue to perform relatively well and add return to a balanced portfolio.